Ellis, the Managing Director of the Linn Group. Many thanks for joining us this morning, Mr. Ellis. A lot of concerns, particularly about the US debt crisis and, of course, the Eurozone as well. How do you digest all this worry, all this concern? What are your clients telling you? Is it a time to really just run for safety?
Well, it's been interesting, really, since the last week of June. We've been on this incredible tear, almost 7.5%, 8% off the bottom in global equities. Exuberance from the passing of the austerity measures in Greece, and then really some end of the quarter, end of the first half of the year gamesmanship here in North America on Wall Street. And then, of course, the break, the 4th of July break here in North America, which got people to thinking, it seems that the Federal Reserve is now no longer buying treasuries, and perhaps maybe the Greek situation wasn't quite solved. And then we wake up after this weekend and discover that perhaps Italy, as much as they try over the last 14 years to get their debt to GDP ratio below 100%, mind you, still 40% above the Maastricht 60% levels, still can't quite seem to get it together. And so I think markets are doing what markets do best, and that is repricing global growth in an unstimulated environment.
And the big concern for you really is about the European debt contagion, is which US banks, and of course that will affect Asia in time as well, but which US banks are really holding the losses? We can't know, can we?
No, you really can't know, and I think that's the fear. It's quite a similar situation that we had both in the Bear Stearns scenario and in, unfortunately, the Lehman scenario. And so what you have is this sort of very delicate dance that a credit crisis ends up turning into a liquidity crisis. And while we don't think that the scale and scope of who's holding the bag where is as large as it was in the housing-related or mortgage-related crises that really gripped the world in late 2008, 2009, there will be substantial repercussions from any kind of credit-triggering event. And that's what we're seeing begin to get priced into these markets. Not only have equity markets sold off over the Monday session, but German Bunds at the highest level this year, really the highest level since the post-crisis scenario, and they're really telling you, as fixed income markets often do, that there is more than just a little bit of smoke here on the horizon.
And if I can ask you one final question, the US auction this week, $66 billion of treasuries, how important is this to gauge investor sentiment, if at all?
Yeah, I don't think it's particularly interesting in terms of engaging or understanding investor sentiment, given the fact that we've had such a large percentage of outside undisclosed buyers for such a long period of time. And certainly, I think the question you're alluding to is, now that the Federal Reserve isn't in there being the sort of primary buyer, who will be? And obviously, that will remain to be seen, but I think we'll have to wait for 2 or 3 more auctions down the road in a post-debt ceiling raised world to understand whether or not investors continue to have an appetite for extraordinarily low yields for an extraordinarily long period of time.
Thank you for joining us this evening, for your time this morning for us. Linn Ellis there, the Managing Director of the Linn Group.